Good afternoon and welcome to today's OptionsPlay webinar, How to Trade Debit Spreads. My name is Scott Green, Marketing Director with Regal Securities, and shortly I'll be introducing today's presenter who does all of our OptionsPlay webinars, Tony Zhang. So with today's topic of how to trade debit spreads, Tony will be going over what are debit spreads, how to deploy this strategy using debit spreads with entries and exits, and more. For those who are unfamiliar or new to the trading platform or OptionsPlay, OptionsPlay can be accessed on your trading platform since it's highly integrated. It's a tool that will help you with analysis, strategy, and research for trading options. And after I introduce Tony, and he will show how, or teach you more about debit spreads and how to use it with the OptionsPlay tool, we'll have time for Q&A at the end. And you can, if you have questions at any point throughout the webinar, please submit them through the chat box or the Q&A box there within the webinar program. And we'll address as many as we can at the end. So next, I just want to go over this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. And so that brings up another point, since this is being recorded, and yes, it will be shared to all those who've registered for this webinar. So be on the lookout for an email from us in the next day or two after this webinar to hear the live recording of this presentation. And now I'd like to introduce Tony Zhang, the options expert and chief strategist at OptionsPlay. Tony has over 12 years of experience in the financial services industry, and at OptionsPlay, he oversees a development team that has led to some of the creation of the most innovative tools in options trading and analysis. OptionsPlay is their flagship product and is currently embedded with several major sell-side brokerage firms, and there's also a direct-to-consumer platform. Tony helped build up the product suite and bring it to market. And Tony is also busy on the speaking rounds. He presents at many conferences, and his next upcoming speaking engagements are at the Traders Expo in Vegas in November, at the Raymond James Advisory Conference, which is just before that in late October, and at the Canadian Options Education Day event in Toronto. That'll be in November. So with that being said, I would like to hand it off to Tony. Tony, go ahead.
Thank you, Scott, and thank you everyone for joining me this afternoon. Let me go ahead and just share my screen. So thanks everyone for taking the time out this afternoon, and welcome back to our options education webinar series. I hope everyone had a good holiday and is back into the swing of things. Today we're going to be talking about how to trade debit spreads. The reason this is actually one of my favorite topics to talk about is because debit spreads really is one of the most efficient ways to go about taking a directional view on an underlying stock or ETF. So most of us trade because we have a directional view on different stocks and different sectors and different things going on in the market, and we want to be able to profit from that. And debit spreads really allow us to utilize options and give us the benefit of options, which is giving us that asymmetrical risk of giving us upside when we're correct, but also limited risk on the downside when we're wrong. And debit spreads is one of the greatest ways to be able to do them. And they're also quite easy to understand, relatively easy to manage, because there are pretty simple rules on how to exit and enter them. So today what we're really going to do is we're going to break down what is a debit spread, when should you use these debit spreads, how do you trade them effectively, and then talking about the strategy management, meaning money management of a debit spread so that you know when to take profits, when to cut your losses. And then what we'll do is we'll spend as much time as we can using OptionsPlay to actually show you some real examples of bullish ideas, bearish ideas, and how you can utilize debit spreads to really take advantage of a bullish or bearish idea on any stock or ETF. I'll spend about 20 minutes or so really breaking down debit spreads, showing you how they work, when you should utilize them so that you're utilizing them correctly. And then what we'll do is we'll spend some time really going through some real life examples to hopefully help you guys become self-sufficient in being able to utilize options play in finding strategies and analyzing them and ultimately trading them in your trading account. So we're going to start off by just talking about what is a debit spread. There's two types of debit spreads that you can trade. If you're bullish on a stock, you can trade a bull call spread. If you're bearish on a stock, you could trade a bear put spread. So very similar to buying just an outright call or a put. Debit spreads are effectively very similar to outright buying a call or a put, but what we're doing is we're adding additional leg to that has some additional efficiencies for transaction cost, for and also for your the amount of risk that you're going to be taking. So before I move on and kind of break down these debit spreads and show you guys how to construct them, I just want to get a feel for the room. If you've traded a debit spread before, or you're familiar with debit spreads, please type debit into the chat window, just so I know who has experience trading these debit spreads. And if you've never traded a debit spread or you don't know what they are, type in no into the chat window, just so I get a feel for the audience here in the room. Okay, so quite a few debits, but also in the same token, quite a few no's. I would say it's almost a 50-50 split, okay? So for those of you that have experience trading debit spreads, what we'll do is we'll really break down kind of when you should utilize them, what are the best practices for them, and more importantly, showing you how you can find debit spreads as quickly as possible so that you don't waste a lot of time trying to figure out which expiration dates and which strike prices, because that also can take quite a bit of time. And for those of you that are brand new, what we're really going to do is break down these, really explain the strategies to you, explain why you should utilize these strategies compared to just buying a call or a put, and then showing you some real examples. And hopefully that inspires you to take a look at these types of spreads, because they are one of the more efficient ways to utilize options to take advantage of a bullish or bearish view. So let's break down kind of what is a debit spread. I'll do two cases, the bull call vertical and the bear put vertical, show you how they're constructed, a little bit about what it feels like to trade debit spreads, and then we'll get into kind of when you should utilize them. So first of all, the first thing you should know about debit spreads, if you've never traded one before, is that you have defined risk or reward when you're trading a debit spread. Unlike buying a call where you have unlimited reward, or if you're shorting other types of strategies where you have unlimited risk, in debit spreads, you know exactly what your max risk and what your max reward is before you get into a trade. And that's really one of the critical parts about trading debit spreads, and it makes them a little easier to manage because you know exactly what to expect before you get into a trade. Unlike many other things, like when you buy a call, you may not know what to expect if the stock goes higher. So with debit spreads, you know exactly what to expect, which usually makes the process of managing them also a little easier, because you're never surprised by what's going to happen. You know exactly what the potential best case scenario and worst case scenario is. So to break down these two strategies, I'm going to use a fictitious stock XYZ trading at $100 because it's nice round numbers. It's easy to understand how to construct them. Now, you don't have to memorize how to construct them because the platform actually does it for you. This is just for illustrative purposes. So for example, if we have a stock XYZ, it's trading at $100 and we're bullish on it. We think it's going to go higher. How do we take advantage of that? Traditionally, if you were just trading single leg options, you would potentially buy a call option. You would buy, let's say, an at-the-money call option. So let's say you buy a 100 strike call option. Let's say that cost you $4. Traditionally, that's what you would do. You'd buy a $4 call option and then wait for that stock to potentially go higher. Now, if you're just buying a call option, if you paid $4 for it, then you're risking $4. So what we're doing here with a debit spread is, instead of just buying a $100 call, we're going to sell a higher call against that. We're going to sell a $100 call. And for doing so, we're going to bring in a dollar credit. So that means instead of paying $4 for that call option, we're now only going to pay $3 because we received a $1 credit for the debit spread, for the whole spread. And what that means is that we're going to have a maximum risk now instead of $4, but only $3. So we're reducing our risk compared to just buying an outright call. However, what we're doing here is that our max reward now is no longer unlimited. It's going to be capped. And it's going to be the distance between the two strikes, which is the $100 call and the 110 call, minus the amount of money that we paid for the call, which is $3. So the max reward here is going to be $7. instead of unlimited. And the reason for this is because when we buy stock, when we're bullish on stocks XYZ, we're not really expecting it to go to infinity. We typically have some kind of target price on that. So that's really how we go about selecting which strike to sell, because we don't necessarily think the stock's going to go all the way to infinity. So why pay for all that upside? You're paying for all that upside when you're buying an outright call. So by selling a 110 call against it, we're basically saying we don't think stock XYZ is going to go above 110. And for that, we're going to receive a $1 credit. That's going to lower our risk. That's going to lower our break-even price. And you're going to learn a little bit that it's also going to decrease the time decay on this spread compared to buying a call. So that's just how you construct a call vertical. Now let's look at the bear case. Let's say you're bearish on stock XYZ instead. It's trading at $100. Maybe you think it's going to go down to 90. What can you do? Traditionally, if you were just buying a put, you would buy, let's say, a $100 put, or a 100 strike put, an at-the-money put. Let's say that put cost you $4. That means your absolute risk is $4 on this particular trade, and you can take advantage as long as the stock goes all the way down to 0. However, chances are it's not going to go down to 0, especially between now and expiration. So what can we do? We can sell a $90 put against it. Let's say we receive a $1 credit in exchange for that. So now, instead of risking $4 on buying a put, we're now only going to risk $3 on buying a put vertical. And same thing here, because we've sold that $90 put, instead of having unlimited reward to the downside, we're going to have limited reward of $7. So the distance between the two strikes, the $100 put and the $90 put, is $10 minus the $3 that we've paid for the call for the spread, gives us the remaining $7, which is our max reward. So when you're trading these spreads, you know exactly what your max risk is, what your max reward is. And the goal of buying these debit spreads is simply to profit from a large directional move in one direction or another. If you think the stock's going to go higher, you buy that bull call spread. If you think the stock's going to go lower, you buy that bear put spread. Okay, so let's actually take a look at these strategies and kind of, and I'll come back to kind of these strategies and how to pick these strikes. But I first want to talk a little bit about the strategy itself, because debit spread strategies are designed to allow you to take advantage of a bullish move or a bearish move or big move. Actually, it's designed to allow you to take advantage of a relatively quick and fast move in one direction or another. Generally speaking, this strategy is better on individual stocks versus ETFs and indices. And the reason for this is because ETF and indices don't typically have very large jumps because they've diversified single stock risk away. You don't have dividends, you don't have earnings, you don't have a lot of catalyst that tends to move ETF and indices a lot. Versus individual stocks, you have a lot more catalyst that can potentially move a stock very quickly in one direction or another. So debit spreads really allow you to take advantage of a quick move in one direction or another. So that's why, generally speaking, debit spreads are generally traded on individual stocks. You can trade them on ETFs and indices. However, they may not be as efficient on those types of symbols. When it comes to selecting expiration dates, this is where it's very similar to buying a long call or a long put, meaning you generally want to go a little further out in time. At least 5 to 8 weeks out is usually the minimum time frame that you want to utilize for a debit spread strategy. And the reason for this is really because longer dated options minimize theta or time decay. And you really want to minimize that time decay whenever you're long options. So debit spread strategy is a strategy where you're effectively long options or long theta, so that theta is always working against you. So in order to minimize that time decay, you want to go at least about 5 to 8 weeks out. So about 1 to 2 months out in terms of expiration date is usually where you want to start looking when you're trading debit spread. As far as the strike prices between the two legs, we usually always say that you want to buy a slightly in the money strike. So if you're buying a call option, you want to start the at the money or slightly below the at the money. If you're buying a put option, you want to be at the money or slightly above the at the money strike for a put. And then when you're selling the second leg, you want to sell out of the money strikes that are away from the current price. Usually we like to use about a 1 standard deviation away is usually a good starting point for where you want to sell that leg, because that represents a price where the stock has a relatively low probability of hitting, or the probability of it going beyond those strikes is usually less than about 15% when you're using a 1 standard deviation strike. So that's how you go about selecting, the stock, the expiration date, and the strike price on a debit spread. These are general rule of thumbs that you would follow if you're trading a debit spread. So next, what I want to explore is really getting an understanding of what it feels like to trade a debit spread. Because I get a lot of comments about when you're looking at debit spreads, the probability of profit on these spreads look relatively low. So I want to just get ahead of that and explain why they're low and what the benefit of they are. So before we can go into that, what I first want to make sure we understand is that when you're trading options, or rather when you're trading any strategy, what you're really trading off is probability and risk to reward. These two properties are inversely correlated, meaning if you have high probability, you're going to have low risk to reward. If you have high risk to reward, you're going to have low probability. So when we're selecting the strikes that are near the money, so when we're buying strikes that are near the money, when we're buying the strike that I just explained, you're generally going to have higher probability of profits. So a lot of debit spreads, you'll see they have probability of profits usually around 35, 33%. Percentage of the trades are winners. And a lot of people ask me, why do you choose trades that have such low probability of trades? Why wouldn't you pick something higher? And the reason for this is because probability is only one half of the equation. Itself doesn't really mean much. Whether you have high probability, low probability really doesn't mean much. What you need to do is look at what the other side of the equation looks like. What is the risk to reward of something? So like most or pretty much all debit spread trades will have what we consider good risk to reward, where we're risking, let's say, $200, but to try to make potentially $500. So that's how we make up for the low probability of profit, is that we have low number of winners, but when we win substantially more money. Conversely, if we buy debit spreads that are far out of the money, so you can buy an out of the money call and sell even further out of the money call, you're going to have even lower probability of profit. So maybe 15% winners, 85% losers. But the trade-off here is that you're going to get much better risk reward. So you might be risking $100 to try to make $900. So even though you might lose on most of your trades, but when you do win, you're winning substantially more than what you're losing on the last few trades. So there's this trade-off between probability and risk reward. And what you're really looking for is not necessarily just high probability or good risk reward. You want to find a balance between these two. So where do you find that balance? That's really what we're trying to help convey. So what we generally find is the optimal debit spread when you're trading a directional view on a bullish or bearish stock. You generally want to buy roughly a 50 or 60 delta call, so just slightly in the money call that's just, or I'm sorry, this is not just calls, this is calls and puts. So you want to buy a 50 or 60 delta call or put, and then when you're selling that leg, you want to sell a 10 to 15 delta call or put. And the rule of thumb here, generally speaking, is the premium that you collect on the short leg is usually roughly about 10 to 20% of the premium that you paid on the long leg, okay? So that doesn't necessarily mean you have to, that's not what you're going to find every single time, but generally speaking, you're going to be able to offset the long legs premium by about 10 to 20%, which actually goes to reduce your risk, and something we're going to talk about a little bit later. But generally, when you're going to be buying these types of deltas, when you're buying a 50 to 60 delta call or put, and you're selling a 10 to 15 delta call or put against that, you're generally going to see that your probability of profit is somewhere around 33%. That's sort of the average that we typically see. And your risk to reward is usually somewhere just a little bit over 2 to 1, where you're risking roughly $100 to make a $200 reward. And the benefit of trading debit spreads versus just buying a long call or a long put is the fact that you're going to have a lower amount of risk. Like we said, because you have a short leg, you're going to reduce the cost of that long leg. That means your absolute risk is lower. It's going to lower the break-even price of the strategy, so the stock doesn't need to move as much in order for your strategy to be profitable. And lastly, because you have a short leg, you have a lower theta, so the lower time decay on your trade. Because whenever you're long an option, time decay is always working against you. You want to be in and out of those trades as quickly as possible. So when you lower your theta and you lower your time decay, you're slightly less time sensitive to how long you're in that trade for. So it allows you to gain exposure to that bullish or bearish move for a slightly longer period of time. So these are all the benefits of why, if you're buying a call or a put, why you should consider taking a look at debit spreads, because they provide these additional advantages which lower your risk, potentially increasing your returns and allowing you to stay exposed in the stock, in the names that you want to be, for potentially a little longer than you would if you were just long a call or a put. So now that we've talked about how to construct a debit spread, what they are, what are the best practices for utilizing debit spreads, now I want to address when should you use them, because I generally have found that not everyone has been using debit spreads correctly, because some people have been taught that they want to use debit spreads when volatility is low, or when implied volatility is low. Now, while that is true, and while that's the ideal time to use a debit spread, that's generally speaking not the only time you should be using debit spreads. Debit spreads are really only useful in terms of profitability when you're expecting a large move, either bullish or bearish move in one direction or another. Now, if you're expecting a bullish move to happen over a slow period of time, or if you expect a modestly bullish or bearish move, debit spreads is not the right strategy for it. There are other strategies that are better suited for modest moves, like credit spreads. So usually when we're talking about using debit spreads, this is usually when you've identified some kind of breakout. A stock has been trading in a range, it's about to break out to the upside, or it's trading in a range, it's about to break down to the downside, when relative strength or trend lines are lining up. So you have both the market and trends working in your favor. Sometimes you have maybe even the sector working in your favor. Sometimes when you expect a news announcement or something like that, or a product launch, some kind of catalyst where you expect a large move. Those are the times that you want to utilize a debit spread. And I'll show you the two side by side in a few minutes to show you why that's the case. But the one thing to really keep in mind is that you should not use a debit spread when you're only expecting a modest move. So if you have a stock that's trading at 100 and you think it's going to go up to 102, 103, a small move, this is not the type of strategy that you generally want to use for that. This is for if you expect the stock to move from 100 to 110 in a month or two. Those are the types of times when you want to utilize a debit spread. So just to recap, if you are bullish on a stock, you want to buy a call debit spread. If you're bearish on a stock, you want to buy a put debit spread. So I just want to illustrate, again, the difference between when we expect a big move versus when we expect a modest move, and when you should consider using debit spread. So here I have a stock that's trading around $100, and I specifically picked this because it's trading around 100. As you can see, this stock was making some pretty big moves, and eventually kind of formed this triangle here, and it eventually hit this apex of the triangle and finally broke out here around this time of the month. And as you can see, you had a big move afterwards. So whenever we expect a breakout, breakouts typically mean that we're expecting typically a fast and quick move to come right after a breakout. That this is the optimal time to enter a debit spread, when we are expecting the stock to make a quick, fast move in one direction or another. Conversely, I have this stock here later ended up trading within a relatively tight range between 101 and about 103. And as you can see, for those of you that are using these type of oscillators like stochastics or RSI or MACD, you're familiar with buying when it's oversold near the bottom of the range and selling when it's overbought near the top of the range. So when you're expecting a small move in one direction or another here like this, especially when you're using overbought and oversold indicators, these overbought and oversold indicators, generally speaking, do not give you a good sense of magnitude. They simply give you a sense of probability, because when the stock is near its overbought, it's high probability the stock will move lower. When it's oversold, it's a high probability the stock's going to move higher. It doesn't really give you any feel for magnitude or how far it's going to go or how fast it's going to go. So for these types of trades, you're better off using credit spreads, which we've covered in a completely different webinar. And we have a recording for that for those of you that are interested. But make sure you understand the difference between trading a debit and credit spread. Debit spreads also, because these types of quick, fast moves are not something you identify very often. These are something you tend to trade debit spreads on different stocks all the time, because it's unlikely that you're going to identify breakouts all the time on the same stock. You're generally going to identify breakouts on different stocks on different days. So debit spread traders typically trade lots of different stocks, versus credit spread traders tend to trade credit spreads over and over again on the same stock. So those are some of the differences between trading debit versus credit spreads. So with that, now that we've discussed kind of what a debit spread is, how they're constructed, what are the best practices, and when to utilize them, how do you actually trade them effectively? Meaning, how do you actually manage these? And the key to trading any option strategy is simply that risk management is absolutely fundamental and key to the success of trading. So we talked about entering the strategy. Entering a debit spread should be timed with when you're expecting a large move in the underlying stock. Exit strategy on debit spreads is also fairly straightforward, especially compared to a lot of other option strategies. So when we're talking about trading debit spreads, we always talk about having an exit plan. Now, that exit plan, number one, should always be with a target price in mind. So if you're bullish on the stock when it's trading around $99, you should have a target price of where you think the stock's going to be. And if the stock goes higher, you certainly should take profit. But if, let's say, this stock didn't move higher, broke out and kind of just continued to move sideways, then you should say that, hey, my plan never worked out and it's time to cut out. So you always want to cut losses if the move that you're expecting does not materialize. So if you're expecting a breakout and it breaks out just by a little bit and then just doesn't continue moving, cut your losses, move on. That is the first and foremost how you should manage debit spreads. Second of all, because debit spreads are just like long calls and puts, you always want to exit them at before expiration. You never want to hold on to a debit spread all the way to expiration. You want to exit before expiration, either at a gain or a loss. And the two rule of thumbs for cutting your losses and taking profits for debit spreads is really easy to remember. And they are the same regardless of what debit spreads you trade. Doesn't matter whether you trade short-dated ones, long-dated ones, near the money ones, out of the money ones. The rules are the same. And that's really why I like to trade them, because they're easier to manage. So you generally want to cut your losses on these trades when you've lost 50% of the premium you've paid for that debit spread. And for taking profits, you generally want to take profits when you've gained anywhere from 75 to 100% gain. At least take partial profits. So if you're trading just one or two contracts, you generally want to take all your profits at that point. If you're trading 10, 15, 20 contracts, you might want to take half of it off at least when you hit these types of targets, and keep another half on if you think the stock's going to continue moving in that direction, and try to go for that 200% gain. Take partial profits, at least around 75 to 100% gain. So those are just the rules that you generally have when it comes to selecting debit spreads, when you should trade them and how to manage them. Let's actually look at some real examples now. I want to show you some bullish setups and bearish setups, walk you through looking at kind of buying the stock, buying the call, or buying that spread, and really showing you why that spread is one of the more efficient ways to really take advantage of a big move. So right now, I'm going to pull up Apple here, and like we said in the disclaimer earlier, this is not by any means a solicitation to trade Apple. I'm just using this for illustrative and purposes because I saw this trade. As you can see, Apple is it's been in a fairly bullish trend. The 1 month and 6 month trend is 1 month trend is neutral. So 1 month trend is pulled back a little. The 6 month trend remains bullish. So this is usually actually a good time to potentially enter a long trade because you're really getting a good risk to reward on a move higher. The technical score is very high, so strong, very strong, telling you this is a strong stock outperforming the market. So let's take a look at, if I'm bullish on Apple and I think this thing's going to make a quick move back up to maybe 230, which is where near its all-time high, how do I actually take advantage of that? The stock's trading at 218 right now. So this, for those of you that are brand new to OptionsPlay, welcome. You can access it through the OptionsPlay tab in the upper right-hand corner, or you can just add a widget here and add OptionsPlay. And we created this because we realized that when you're analyzing options, chances are when you're using an option chain, there's a lot of different expirations and strike prices. And sometimes it's really difficult from this page to determine which strike you should buy. More importantly, if you're bullish on Apple, you think it's going to go to 230, how do you tell the difference what the 215 versus 220 calls are going to give you in terms of return? And it's really difficult to compare one expiration to another expiration, and certainly almost impossible to compare one vertical spread to another vertical spread. So that's really why we created OptionsPlay, because the things that you needed to do on this page just simply weren't available in terms of analytics. And especially for those of you that are brand new to options trading, this page is quite overwhelming. Trying to understand what all the different numbers mean. We wanted to create a new user experience for options trading that actually broke down the different strategies, allow you to put just a few strategies side by side so that you can really analyze them and understand these strategies, so that not only do you learn and analyze them, so that you can ultimately be able to trade these effectively. So right now, let's say Apple's trading around 218 right now. Let's say I'm bullish on it. You can click on I'm bullish here for Apple, and we'll present to you 3 bullish strategies on Apple. So you can either buy the stock, which will cost you $21,000. You can buy a call option, which costs you $915, or you can buy the spread here. This is the debit spread. So we're buying the 217.5 call, so the slightly in the money call, and then we're going to sell a 240 call against that. That 240 call is already a call that's optimized for you based on the November 2nd expiration date. And November 2nd is 45 days out, because that's usually a good starting point if you're buying options, is somewhere between 1 to 2 months out. That's where most people are trading long options. It's really 1 to 2 months out. So we're going to compare these 3 strategies side by side. And for those of you that have never traded these strategies before, this is designed to give you starting points without you having to first pick something, because chances are if you're starting out, you probably don't know which ones to even pick to start with. And for those of you that have experience trading debit spreads, this is really designed to save you time. We used to spend hours and hours on the option chain going through different strikes, different expirations, different combinations, and then taking those combinations, plugging them into some kind of analytics tool to analyze them. We wanted to do this so that it's much easier for you to analyze and get you to the starting point much, much quicker. So we have these 3 strategies side by side, and what we have is a P&L simulator. This is really what you're after, because you want to know how much money am I going to make if the stock goes in my favor, and how much money am I going to lose if the stock goes against me. This is the information that you couldn't tell by using the option chain. As a trader myself, back in the day, I used to make really back of the envelope calculations to get an approximation, but they were always approximations, and it was really difficult to compare one strategy to another. So that's why we built a P&L simulator, so that you can say what happens if the stock goes up to 235, which is where we thought maybe the stock might go in a couple of months. And let's say we think the stock's going to go from 218 to 235. How do these strategies actually perform, so that I can compare them and decide which one's best for me? So if you've never traded an option before, you buy a stock. The stock will return you 7.5% if the stock goes up to 235. A nice return, a nice positive return. However, if you bought the call option here, you make a 91% return. So it's a significantly higher leverage by buying a call option, even though it costs you just a fraction of the amount of money it would cost you to buy 100 shares of stock. And then conversely, the strategy here on the right gives me 132% return on my money, because it actually cost me only $752 to get it. So the reason that you're getting such a low return on the stock is because it costs you so much money to buy 100 shares of that stock. Buying a call option costs you a fraction of it, which increases your returns. But if you buy this debit spread, you're increasing your returns even further. So this is really designed to help provide you with the most possible efficient way to take a directional view while limiting your risk. Because as you can see here, if I'm correct, I'm actually going to make a fairly nice return here on the spread. But what happens if I'm wrong, right? We don't have a crystal ball. The stock can easily plummet. Let's say it goes back down to 205, which is where it was just a few weeks ago. What happens if we're wrong on this trade? What happens if the stock goes down to 205? As you can see, if you had bought 100 shares of the stock, you lose $1,300. You're risking quite a bit of money, because you can risk actually up to $21,000 if the stock goes to zero, but that's fairly unrealistic. But we certainly think that it's possible the stock can move back down to 205 with a fair amount of certainty. But if you bought the call option here, you lose $915, because that's what you paid for that call option. No matter what happens to the stock, even if it goes to zero, the most you'll lose is $915 per contract. So compared to buying the stock, you're actually risking less money, even though you're making a higher return if you're correct. And then lastly, on the spread here, as you can see, if the stock goes down to 205, I'm risking even less, $752, almost half the amount of money that I'm risking if I had bought the stock, even though it only cost a fraction of the cost to buy that stock. So that's why these spreads here on the right, the debit spread here on the right, is one of the best and the most efficient ways to take advantage of a bullish view on an underlying stock, If you expect a quick, fast move like we see here, if we expect the stock to move up to about 230, let's say 230, as you can see, at 230, the comparisons are still the same, where you have a 5% return on the stock, 36% return on the call. Not as attractive here, but the spread here on the right gives you a 66% return if you think it's going to go up to 230. But then if you think it's going to go even further, that's when the returns really magnify. And then if you really think the stock's going to take off, let's say you think it's going to go to 260 in the next 45 days, which in my opinion is quite aggressive, but let's just say you do. Now you can see this is when the debit spread really starts to underperform, because we've sold that 240 call against it, which means that we're not going to be able to take advantage of any profits if the stock goes above 240. So if the stock goes all the way up to 260, it's really this call option that's really allowing you to take advantage of that. So it's only in the scenario where the stock really takes off where buying the call is better than buying the debit spread. But the reason that we're selling these one standard deviation spreads is because there's relatively low probability of the stock going above 240 by November 2nd. There's only less than a 15% probability of that happening. And generally speaking, that savings that you're going to get, that roughly $150 savings that you have here on the call spread versus just an outright call, will greatly offset the possibility of the stock going that much further. Because the chance of the stock going up to 260 is probably less than 1 to 2%. It's not worth taking that on, paying that additional $150 for that 1 or 2% chance. So that's why these debit spreads here on the right really give you that advantage of being able to take a bullish view while minimizing the absolute amount of risk that you can take on this specific type of trade. And even if you expect the move to happen relatively quickly, so if let's say instead you think the stock's going to move up to 225 just in a short period of time, as you can see, that this is really where also the spread here will still be able to take advantage of that move relatively quickly versus just buying that stock. So you can use our P&L simulator to simulate any type of move. So if you think the stock's going to move up to, let's say, 230 in a relatively short period of time, you can also see here exactly which strategy is best for you. And this is really designed to allow you to learn about these strategies, see how they perform before you get into a trade, so that nothing really surprises you after you get into a trade. That's something that we see a lot from traders, is they buy a call option and they don't really know what to expect. If you fall into that category, use our P&L simulator. See exactly what happens to the call option if the stock goes higher. See what happens if the stock goes lower, so that you already have an understanding of what to expect, so that you're not you don't get blindsided after you get into a trade. Now, one of the best parts about the integration that we've done with Regal Securities and with OptionsPlay is that we know that entering these types of orders sometimes is very tedious because there's a lot of different things that you need to manage when you're entering them. We have what's called the trade preview order. So we first explain to you how the strategy is constructed, which leg you're buying, which leg you're selling, so you know exactly what that is. You have the bid-ask spread so that you can see what it's trading at. But we also have a strategy checklist. This is for those of you that are brand new, who have never traded these strategies. Make sure you understand the risk of these strategies. So are you trading with the trend of the stock? Are you trading with the trend of the market? What's the OptionsPlay score? Is there earnings between now and expiration? So this is telling you Apple has earnings on November 1st. So something to be aware of if you're trading a November 2nd expiration is that there's earnings between now and expiration. Something to be aware of before you get into a trade, not after. And then lastly, we look at the spread, meaning how liquid is this option. So here, everything looks pretty good here. I'm aware that there's earnings, which is good. So I'll probably close this out before expiration. So once I'm ready to place this trade, I can hit the preview order button, and that actually pre-fills the ticket for you. You don't have to pull up the option order ticket and enter everything manually. Everything is done for you so that you are able to enter this trade as quickly as possible without having to do anything manually. Okay, so this is all designed to make your life as easy as possible in terms of finding the strategy, analyzing the strategy, and once you're ready, hitting that trade button so that you can send this off for execution. Now what I want to do is now I want to flip this on a dime, because now I want to take a look at a bearish strategy. For those of you that have never traded options before, you may not have looked for bearish opportunities because perhaps you've never shorted a stock, or perhaps you don't have the ability to short a stock. By adding options to your repertoire, you're able to now look at potentially double the amount of trading ideas, because now you can look at bearish stocks. I'm going to take Micron here because this is a fairly popular stock that a lot of people follow. That's really fallen apart over the last few months. This was a high-flying stock, one of the best stocks in the market, really started to fall apart over the last few months. Took a nosedive over the last few weeks and really came back a little, right near around that 46 support level, which is where it was back in mid-August. Broke down to the support level and then came back to test it. So here's where, I think that perhaps we could get a bounce lower, move back down to maybe 39, even potentially lower. As you can see, this last move down was from about 52 to about 42, so about a $10 move. So it's not crazy for me to think that this stock can move another, $7-8 lower from about $45. So let's take a look at this Micron trade. So here, instead of selecting I'm bullish, I'm going to select I'm bearish on Micron. So now we're going to have 3 bearish strategies. This is designed to show you if you shorted the stock, what you would get, if you bought a put option, what you would get, and what if you bought that put vertical. This is that debit spread that we're talking about. So here, shorting that stock will require a certain amount of margin requirement to do so. Buying a put option only costs you $365. Buying that put spread only costs you $314. So this is your absolute risk. And keep in mind that when you're shorting a stock, your risk is really unlimited because if the stock goes back up to 90 or further, you're going to lose more and more money. So your risk is truly unlimited when you're shorting a stock. And that's why we generally don't ever recommend shorting a stock, because you can take advantage of that bearish move using a put option with limited risk. So why would you take unlimited risk when you have the option of taking limited risk? And this is really why we always encourage users who are bearish on the trade to look at put options and put spreads, because it allows you to take that bearish view with limited risk. So here, Micron's trading around 45. We're going to use our P&L simulator here. Let's say we think the stock's going to go down to $38 over the next few months. So it made a quick move down $10 in just 2 weeks. So I don't think it's crazy to think that this stock's going to move down, let's say $7 over the next month and a half. So here, as you can see, if you had shorted the stock, you make a pretty nice hefty 15% return in a few months. But if you bought this put option here, you actually make 119% return. And if you bought this put spread here on the right, you make 154% return. This is really why this is one of the most efficient ways to take a bearish view. And at the same time, you're only limiting your risk to $314 per contract. So there's nothing else that really allows you to take advantage of a bearish view on a stock as cheaply as a debit spread allows you to do so. And conversely, what happens if we're wrong? What happens if Micron really turns back around and goes back up to 53, which is where it was just a few weeks ago? Not entirely crazy, unlikely, but not crazy that it's going to go up to 53. But if it does that, if you had shorted the stock, you lose $785. Which is quite an amount of money considering the stock's only at 45. It would only cost you $4,500 to buy 100 shares of it. If you have bought the put option, you lose only $365, so half of what you risk if you had shorted the stock. And if you bought this put spread, you only lose $314. So the least amount of money you're actually going to risk by trading this put spread. Again, that's why the debit spread is one of the most efficient ways to really take advantage of a bearish view with limited amounts of risk, which is really key, because whenever you're trading anything, the more you can limit your risk, the more likely you'll be more successful and more profitable in your trading, because successful traders is really more about managing risk than it is about being right. If you're managing your risk correctly, that's when you're able to take advantage of that upside. So even if you're wrong on these types of trades a few times, all it takes is for you to be right once, and you're going to be able to recoup many of your losses on these debit spreads. So again, you have low probability of profit here, only 42%, but your max reward is $586 versus your risk is only $314. So one single winning trade will easily offset a couple of losing trades, and that's really why debit spreads, even though they have low probability of profits, should still be a strategy that you should look at if you're bullish and bearish and you're expecting a relatively quick move in one direction or another. So with that, just to recap, once you're ready for trading, you hit the trade button. You should use the strategy checklist to make sure that you understand the risks of everything that you're trading, checking to see if there's earnings. There's actually earnings here on September 25th. Which is just coming up. So maybe that might sway your decision as to whether you want to place this trade or not. And then if you're familiar, if you're okay with it, hitting the preview order button allows you to send this order for execution immediately, so that you don't have to spend any more time entering the orders or potentially making a mistake on your order entry screen. So with that, I just want to thank everyone for taking the time out this afternoon to listen to this webinar. I hope you guys have found this useful, especially for all of you that think that that are new to options trading and have never traded a debit spread before. I hope you guys have found this useful. And at this point, what I'm going to do is I'm going to open this up for Q&A. And if you have any questions, please type them into the chat window or type them into the Q&A window, and I will answer as many questions as I possibly can. Chandra's asking, when will OptionsPlay come to mobile app? Great question. There's some concerns about what we can actually fit into a mobile app. You know, there's a lot of information here. This is connected to a web-based trading platform. That's why, you know, at this point, it doesn't really fit inside a mobile app, but it's something that we are exploring as a standalone platform with less functionality. But it's really difficult to fit all of these things currently into a mobile app, but it's something that we are exploring. So thank you for that question. Pat's noticing that the earnings date on MU is incorrect. He's saying that it's on September 20th. That's actually something we are aware of. So just for information purposes, MU is announcing earnings tomorrow, not on the 25th. We are looking into that issue right now. Where do you find standard deviations? Great question. So one of the things that if you're interested in understanding what the standard deviation moves are, there's two ways you can do that. Number one, we have 4 dots here on the bottom. I didn't have time to go through everything, but the 4th dot is the trading range simulator. This allows you to select any expiration date and see what the one standard deviation move is for each expiration date. So if you want to look at, let's say, a longer dated expiration like the January 2019, you can select that and we'll show you what the one standard deviation move is. The other way you can do it is if you just simply hit modify. On the strike dropdown, we will actually, not only on the strike dropdown do we tell you what the premium for each strike is, but we also tell you where the one standard deviation move for that strike dropdown. So especially when you're selecting strikes for debit spreads or credit spreads, you can easily know exactly where the one standard deviation move is already on your strike dropdown menu. Great question, James. Let's see. Ronald, are there any particular moving averages that are better for debit spreads? So moving averages, in my opinion, is not what you would typically use to find a big directional move. Moving averages is more so giving you an idea of trend. So that's actually what our 1 month and 6 month trend indicators are based off of. We use everything from a 21 to 50 to 200-day moving average to determine these trend indicators. But you generally don't use you generally don't use moving averages to say we're expecting a large quick move in one direction or another. You typically use things like breakouts, breakdowns, so more chart patterns than chart indicators typically will tell you a big move is about to happen. You generally wouldn't use moving averages for that. I know a man that uses 8, 21, and 34-day moving averages. I do not know why, but he does a lot of debit spreads. Okay, so if he has some kind of system using these types of moving averages where he finds quick, fast moves, certainly. I'm not as familiar with this specific strategy in place, but if you know someone who uses them, I would figure out, number one, how they're using them, and if you can, possibly back testing their strategy and saying, what is the average move from these types of signals, and that will give you an idea as far as whether debit spreads is suitable for those types of trades or not. Ronald, what kind of liquidity should I look for in a debit spread? So what we do is here, we have that trading button. We actually look for spread and liquidity. We look at the bid-ask spread between the buy and the sell price and determine liquidity. So we actually color code this for you to tell you what liquidity is. We usually say that as a beginner, you usually want to stick to something with a green or yellow warning sign. That means good liquidity or average liquidity. I generally would tell beginners to avoid something with a red warning sign that's telling you poor liquidity. For those of you that have more experience trading and are familiar with getting in and out of trades, you may trade something with lower liquidity. I certainly have traded them myself, but it's just something that you generally want to avoid if you're a beginner to options trade. Colleen's asking, once in a debit spread, what is the quickest way to exit? So that is a question for your broker in terms of what's the fastest way to enter an order. But usually you would go to your positions. The fastest way to exit is simply placing a market order. Now, if you're trading some of these big names, anytime you're talking about names in the S&P 100 or the top 100 names, you usually can place a market order and get a pretty decent fill on them. But if you're trading a small cap name or a name that's not very liquid, you would want to work those orders at the limit order. So, but I would call your broker in terms of what is the fastest way to enter that order. Usually you find your positions in your position tab, and you can enter a closing order based through your positions tab relatively quickly. I am not at all familiar with OptionsPlay. How do we use the platform through our broker? Well, you access OptionsPlay through the OptionsPlay tab here. We've recorded, at this point, probably at least 10 different topics on OptionsPlay, showing you how to utilize OptionsPlay for all different forms of options trading. So I highly recommend you to take a look at some of those videos and the webinar recordings to help familiarize yourself with options. But the goal here with OptionsPlay is simply to make options easier to understand. And the reason for this is because the option chain is sometimes difficult to navigate. The option chain is very useful for certain purposes, but for the most part, when it comes to trying to select which expiration or which strike price, there are many limitations because, like we said, if we think Apple's going to go up to 230, how do you know what the returns for each strike is or what the returns for different strikes are? How do you compare them? It's difficult to do that from an option chain. That's why we created OptionsPlay, so that you can really compare different strategies side by side and see how they perform, so you know exactly what strategy gives you the best returns and what strategy gives you the risk profile that you're really looking for, as opposed to just really more of an educated guess when you're using the option chains. Can I see the next earnings date easily? Yeah, so you can type in any stock and we'll tell you where the next earnings date is right here at the bottom of your screen. So the earnings date right here at the bottom of every single chart, type in the stock and we'll tell you when the next earnings date is. You said OptionsPlay will be integrated into Regal's platform. It already is integrated into Regal's platform and there's no charge for you as long as you have a live trading account with Regal Securities. So if you don't have access to it, please contact your broker. They'll be able to help you set up with this. Hey, Scott, do you mind sending everyone the link to the webinar recordings or the previously recorded webinars to the group, just so that everyone can get access to the recordings? We have a few questions about how to access those recordings. Bill
Sure.
saying,
yeah, I can do that.
Chandra saying, I trade through eOption. I see OptionsPlay app. Can I integrate eOption through OptionsPlay app? So the eOption, so your OptionsPlay within your broker's platform is only available to you through your broker's platform. That's why it's free of charge to you. You can actually subscribe to OptionsPlay, but you're going to have to pay additional membership for that. So I highly recommend you guys have access to it for free through your broker. Use it. Why you don't pay for it if you don't have to, in my opinion. So please, it's free of charge to you. You guys should all check it out. It's really useful in helping you guys better understand options, especially for those of you that are brand new. This is designed to help provide you with starting points, give you all the analytics so that you can understand these strategies and decide which one's best for you. And for those of you that are experienced with options trading, this is designed to save you time because you can type in any stock, and within 2 seconds, have 3 strategies for bullish. So if, let's say for whatever reason you're bullish on McDonald's, you can click on I'm bullish to look at the 3 bullish strategies. Or if you're bearish, click on I'm bearish and have 3 bearish strategies. As opposed to you would typically have to scroll through pages and pages of these screens, have to pick certain expirations and strike prices first, do some back of the envelope calculations, then decide. It's a very tedious way of trading versus OptionsPlay really makes it a lot easier for you guys to analyze these strategies. So Scott just posted a link in the chat window. For those of you that are in the Q&A window, please open the chat window and there's a link to all of our previous past webinar recordings. So if you want to listen to ones on covered calls, on credit spreads, technical analysis. We have a lot of different recordings that we've already done. You can view them there. So if you want to really learn more about OptionsPlay and how to utilize them efficiently, you can do it through those links. Any more questions regarding what I went over here today about debit spreads? David, you're very welcome. Faye, you're welcome as well. Any last questions? If not, David, you're very welcome. If there's no more questions, I just want to thank everyone for taking the time out this afternoon. Appreciate everyone for coming, to coming back to the webinars and learning about these spreads. We do these for you. So if you have any questions about this, or if you have feedback, please send them over to us. We'd be happy to kind of incorporate any feedback into our future webinars. Or if you have specific topics you want to go over, we certainly can look at adding some new topics. So thank you everyone for coming this afternoon. I hope you guys have a great afternoon, and I will see you on the next webinar.
Yes, and thank you, Tony. Great stuff as always. This is really great information on debit spreads. And as mentioned, we do have a recording of this that we'll be sharing with everyone soon. Thank you everyone for attending and for all your questions. We love the questions, keep them coming. And if you have any more, please reach out to your broker customer service. And just a reminder, again, this is how you can access OptionsPlay on your trading platform. There, OptionsPlay across the top in the tab there. And again, yeah, if you have any questions or comments or feedback, please reach out to the brokerage support team. We will have another webinar next Wednesday. That's September 26th, same time of 3:15 Central Standard Time. And I believe the topic will be gaining a directional advantage, so gaining a directional edge. So be on the lookout for an email for that next one, so you can register. And yep, we look forward to that next week. Again, we'll have Tony on. And thanks again, everyone, and have a great rest of the day. Bye-bye.